Please pay attention to gold and silver prices over the next few weeks. Here I will explain as simply as I can. Check trading economics every day. All right, let's talk about something that sounds boring but is actually terrifyingly important right now. The U.S. bond market. On August 7th, 2026, the bond market sent a message so loud that anyone paying attention should sit up and take notice. Here's the headline in plain English. Short-term U.S. debt is paying 3.69%, but long-term debt, it just spiked to 5.20%. That is a massive gap, the biggest we've seen in years. So, what does that mean for your money, the U.S. dollar, and the price of gold and silver? Stick with me because we're going to break this down so simply that even if you've never bought a bond in your life, you're going to walk away smarter than 90% of the internet. First, let's define our terms. The yield curve is just a fancy chart that plots interest rates against time. Think of it like a financial thermometer taking the temperature of the economy. It has 3 zones. Zone 1 is the short end. These are loans for a few weeks or months. Right now, they're at 3.69%. This is anchored directly to what the Federal Reserve is doing with interest rates today. Zone 2 is the belly. That's the 2-year to 7-year range. It's sitting between 4.21% and 4.50%. This shows us what investors think will happen over the next few years. Zone 3 is the long end, the 10-year and 30-year. This is the big one. It's sitting at 4.65% and a whopping 5.20%. Here's the key takeaway for this part. The curve is super steep. Short-term rates are low-ish, but long-term rates are spiking. Why? Because investors are terrified of 2 things: inflation and government debt. Let's zoom in on that 5.2% 30-year rate. Why is it so high? Reason number 1, investors want to guarantee that they aren't losing money to inflation for the next 3 decades. If they lend the government money for 30 years, they need a high return. But here's the scary reason. The U.S. government is sitting on over $39 trillion in debt. To keep the government running, they have to sell a mountain of new bonds every single month. Imagine you walk into a store and there is so much stuff on the shelves that the store has to slash prices, right? Well, with bonds, it's the opposite. When the government floods the market with a massive supply of debt, investors turn around and say, "Hey, if you want us to buy all of this debt, you're going to have to pay us a higher interest rate." That is what is happening right now. It's a supply problem. The government is addicted to borrowing, and the bond market is making them pay the price. Okay, let's get a little nerdier for 60 seconds. The U.S. also sells something called TIPS. That's Treasury inflation-protected securities. These bonds adjust their payout based on inflation. By comparing regular bonds to TIPS, we can see exactly what the market thinks inflation is going to be. The math says the market is pricing in about 2.2% inflation across the next 5, 10, and 30 years. But here's the kicker. The real yield on those TIPS is 2.39%. That is historically very high. It means investors are actually getting paid well above inflation to lend money to the government. Normally, this would crush gold, because if you can get a safe 2.39% return above inflation from a government bond, why would you own a shiny rock that doesn't pay you anything? But we are not in a normal market, and that brings us to the dollar. Right now, the U.S. dollar index, or DXY, is strong. Why? Because yields in the U.S. are way higher than in Europe or Japan. If you're a global investor, you want to park your cash in the U.S. because you get a better return. Higher yields equal a stronger dollar. But there is a ticking time bomb. If the 30-year yield keeps climbing past 5.20% just because the government is borrowing too much, and not because the economy is booming, that strength turns into a liability. Here's the chain reaction. 1. The government can't afford the interest payments. 2. The Federal Reserve gets pressured to step in and buy up the debt. That's called quantitative easing, aka printing money. 3. Printing money floods the market with dollars. 4. The value of the dollar crashes. So a high yield makes the dollar strong today, but that same high yield is setting up the dollar for a massive crash tomorrow. All right, so how does this affect the price of gold and silver? Let me introduce you to the 3 phases of gold. Phase 1. Yields go up and gold gets crushed. It's mechanical. People sell gold to buy those high-yield bonds. We've been in phase 1 for a while. Phase 2. Yields stay really high, but inflation isn't going away. Investors start to get nervous about how much the government owes. Gold stops falling, and then we hit phase 3. That is where we are heading. This is where yields peak, because they are so high they choke off the economy or threaten government survival. The Fed has to step in and cut rates or print money. That is when the dam breaks, when the Federal Reserve inevitably has to step in and save the government from its own debt. Gold and silver are going to launch higher. And with silver, it's even crazier. Silver is used in solar panels and electric cars. We already have a physical shortage of the metal, so when the bond market headwinds disappear, silver is going to have massive asymmetrical upside. So let's wrap this up with what you actually need to watch. Watch the 30-year yield. If it crosses 5.50%, the government's debt problem is reaching a breaking point. Watch real yields. If those 2.39% real yields start dropping, gold is going to take off. Don't panic about the strong dollar. It's strong now, but the structural cracks are everywhere. The bond market is basically screaming that the U.S. fiscal path is unsustainable. High yields are keeping the dollar afloat and keeping gold suppressed for now. But the headwinds are temporary and the tailwinds are building. If you found this breakdown helpful, hit that like button and subscribe for more deep dives into the economy. Drop a comment below. Are you buying gold, silver, or staying in cash? Thanks for watching, and I'll catch you in the next one. If helpful, please like and subscribe.